DeFi savings accounts. Get high interest on your crypto in 2025, risks and rewards. Are you sick of the low interest rates that regular banks offer? Decentralized finance, DeFi, savings accounts are a great option because they promise much higher returns on your cryptocurrency holdings. But there is a lot of risk that comes with big rewards. This guide goes into detail about DeFi savings accounts, covering the pros and cons and how to safely navigate this new area in 2025. What are savings accounts in DeFi? The basics: you can earn interest on your digital assets in DeFi savings accounts, which are cryptocurrency-based accounts. DeFi savings accounts work on decentralized blockchain networks, which cuts out middlemen and lowers overhead costs. This is different from regular savings accounts offered by banks. This lets them give out much higher interest rates, which are often called annual percentage yield, APY. How do savings accounts in DeFi work? Most of the time, DeFi savings accounts lend out the cryptocurrency you deposit to people who need it in the DeFi ecosystem. These borrowers could be traders, other DeFi protocols, or people who want to use their crypto holdings to make money. After that, the platform takes a small fee and gives the interest to the depositors. Over-collateralization. A lot of DeFi lending platforms require borrowers to put up more collateral than the amount they are borrowing. This lowers the chance of default. Smart contracts. These are pieces of code that automatically enforce the terms of an agreement. They govern all transactions and agreements. This helps to keep things clear and safe. Liquidity pools. You may have to put your crypto into liquidity pools in some DeFi savings accounts. These pools give decentralized exchanges, DEXs, liquidity, which lets people trade cryptocurrencies without having to use centralized middlemen. Why are the interest rates on DeFi so high? There are a number of reasons why DeFi savings accounts have high interest rates. Lower overhead. DeFi platforms don't have to pay for physical branches or hire a lot of people, so their overhead costs are lower than those of traditional banks. More competition. There are a lot of platforms in the DeFi space that are competing for users' deposits. This makes interest rates go up as platforms try to get more customers. More risk. People generally think that DeFi investments are riskier than traditional ones, which is why the interest rates are higher. New token incentives. To get more people to use their platforms and make them more liquid, some DeFi platforms offer their own governance tokens as rewards. Looking into the different kinds of DeFi savings accounts, there are many different types of savings accounts in the DeFi ecosystem, and each one has its own set of features and risks. Lending platforms, like Aave and Compound. You can use these platforms to lend your crypto to people who need it and get interest on it. They usually have interest rates that change based on how much of something is available and how much people want it. Pros. Well-known platforms and markets that are easy to get into. Cons. Interest rates that change and the chance of smart contract hacks. Yield aggregators, like Yearn Finance. These platforms automatically move your money between different DeFi protocols to find the best interest rates and maximize your yield. Pros. It makes the yield farming process easier and gives you the most money back. Cons. More complicated and more expensive. Liquidity pools, like Uniswap and SushiSwap. You can make money by providing liquidity for decentralized exchanges through these pools. Pros. The chance of getting a lot of money back, and it helps the DeFi ecosystem. Cons. Smart contract risk and loss that isn't permanent. The risks you must know about before you invest. DeFi savings accounts can be very profitable, but it's important to know the risks that come with them. Risk of smart contracts. DeFi is built on smart contracts, but they can also have bugs and be hacked. You could lose the money you put into a smart contract if it gets hacked. Impermanent loss. For liquidity pools, impermanent loss occurs when the price of the tokens in a liquidity pool diverges significantly. This could make liquidity providers lose money. Risk of volatility. The value of cryptocurrencies can change a lot. You could lose money if the price of the cryptocurrency you deposited goes down, even if you are earning interest. Rug pulls. This is a scam in which the people who made a DeFi project leave it and take investors' money with them. Uncertainty about regulations. The rules for DeFi are still changing. New rules could make DeFi savings accounts illegal or less useful. How to pick a safe DeFi savings account. Do a lot of research on the platform. Before you put any money into it, make sure you know about its reputation, security measures, and history. Know the risks. Be sure you know the risks that come with the kind of DeFi savings account you are thinking about. Start small. Only put in what you can afford to lose. Don't put all your eggs in one basket. Spread out your investments. Spread your crypto investments across several DeFi platforms. Get a hardware wallet. Keep your cryptocurrency safe from hackers by putting it in a hardware wallet. Protect your private keys. Don't ever let anyone else see your private keys. Some DeFi savings platforms, do your research before using. Aave, a well-known lending platform that supports many different cryptocurrencies. Compound, another well-known lending platform that puts a lot of emphasis on security. Yearn Finance, a yield aggregator that makes it easy to find the best interest rates. Important points. DeFi savings in 2025 compared to regular savings accounts. DeFi savings accounts may let you earn much more on your cryptocurrency holdings. But they also have a lot of risks. You can safely navigate the world of DeFi savings accounts and maybe even make a passive income on your crypto if you know the risks, do your research, and take the right steps.